Treasury Secretary Janet Yellen says she is closely monitoring financial markets as volatility rises. Well, don't I just feel safer already? But as always, it's the details of what she says that matters. And when you get down into the nitty-gritty of her comments today, you should be very worried about what she's proposing. Treasury Secretary Janet Yellen cautioned that stresses in the global economy and markets hold the potential to disrupt a U.S. financial system that has so far proved resilient in the face of those shocks. The world faces a dangerous and volatile environment for the global economy, including the surge in energy prices and increased volatility in financial markets. In such a situation, financial stability risks could materialize. Now, what Yellen is referring to here is any number of situations going on overseas, the economic collapse happening in China, the situation with the Bank of England having to intervene in the UK gilt market, the European energy crisis. Take your pick. Every one of these crises is causing interest rates to rise, and you can see that clear as day right here in this chart. This is the benchmark U.S. 10-year Treasury yield. This is the interest rate by which all other interest rates are based and measured. And of course, you can see here, starting in January, interest rates on the 10-year yield have started to rise, and they have climbed steadily all throughout the year, now sitting at over 4.2%, which are rates we haven't seen since before the global financial crisis. This is being caused by the fact that there are way more sellers of U.S. debt than there are buyers. When someone sells a bond, the price goes down and the interest rate goes higher. And right now, all the big players in the bond market are sellers. The Federal Reserve is selling bonds through quantitative tightening. The Bank of Japan, China, all the biggest holders of U.S. debt are currently selling bonds, and that's driving these interest rates higher. And Janet Yellen is worried about a feedback loop developing where higher rates causes more selling, which causes higher rates, on and on we go. But it was these comments right here about halfway through the article that really leapt out at me and made me think, oh my God, what are these people up to? And here we go. Yellen also flagged the risk of strains stemming from private credit. We are also attentive to the possibility that higher market volatility could expose vulnerabilities in non-bank financial intermediation. Regulators have been working together to better monitor leverage in private funds and develop policies to reduce the first mover advantage that could lead to investor runs in money market funds and open-end bond funds. And you really have to break this statement down to realize just how serious this really is. So she's talking about the dangers from private credit, the dangers from money markets and open-ended bond funds. The big players, the governments, the central banks, they're all selling treasuries. And Janet Yellen is worried that smaller investors will soon join in this selling and create what is essentially tantamount to a bank run on U.S. treasuries. And it was this phrase here, reduce the first mover advantage that could lead to investor runs, that really scared me. See, during a bank run, the people who withdraw their money first, they don't suffer any losses. It's the people who are late to the exits that take all the losses. And money market funds and open-end bond funds, while these aren't banks, these are financial instruments that invest most of their money in very liquid U.S. government bonds. The main draw of these funds is that you can very quickly convert them to cash. They are very liquid instruments. And so people who have large amounts of cash tend to park it in these money market funds or these open-end bond funds as a way to earn a little bit of yield with the comfort of knowing that they can get their money out at a moment's notice. Now, during a run on an investment like this, what would happen is the selling pressure of people selling their bonds would drive the value of those bonds down and the interest rates up. And so the people who get out early are incentivized and the people who get out late are penalized. Now, my first thought when I saw that was Yellen was talking about putting some kind of a limitation on redemptions from these products. In other words, doing something either through fees or penalties or delays, limiting the rate at which people can exit these products. Kind of like when there's not a lot of liquidity in, say, the seats on the lifeboats of the Titanic, well, locking the poor people below decks and not letting them stampede out onto the deck to compete with the rich people for those seats. That's one way to improve liquidity conditions in the lifeboat market. Of course, it's not so good for the people who are locked below decks. And that is when I found this proposed rule from the SEC going all the way back to December of 2021. The Securities and Exchange Commission is proposing amendments to certain rules that govern money market funds under the Investment Company Act of 1940. The proposal would require institutional prime and institutional tax-exempt money market funds to implement swing pricing policies and procedures to require redeeming investors to bear the liquidity costs of their decisions to redeem. In other words, they are proposing to make it more expensive for small investors in money market funds to pull their money out of those assets during periods of tight liquidity, which is what we're in right now. Now, I should add that these are only proposed rules right now. The SEC has proposed these back in December, but this could be one of the methods that Janet Yellen is thinking about using in order to reduce that first mover advantage by making people who sell out of these products pay a higher fee for doing so. You could discourage people from making a run on U.S. Treasuries. Now, I couldn't help but think when I saw this that wouldn't that kind of defeat the whole purpose of these products? The whole reason people put their cash in money market funds or in open-ended bond funds, because you can very easily convert those products back to cash and get your money out at any moment. So putting a rule like this in place would kind of defeat the whole point of these products in the first place. So if Yellen and the SEC aren't careful in trying to prevent a bank run before it starts, they might actually trigger said bank run, because as soon as investors get wind of this proposal, what do you think they're going to do? Well, they're going to start pulling their money out of those funds before it becomes law. In other words, they're going to drain liquidity even more from the bond market, and they'll create the bank run that they're trying to avoid. Now, I remember when I saw all this, thinking to myself, they couldn't really be this sinister, right? That they wouldn't try to solve a liquidity crisis by just outright forcing people to hold these investments, would they? So I called my buddy Joe Brown over at Heresy Financial. He's one of the best brains in financial YouTube. I'm going to put a link in the description down below to his channel. I highly recommend you check that out. And Joe pointed out something that I had almost forgotten about, that there is a growing movement to create a new buyer of last resort for U.S. Treasuries outside of the Federal Reserve. Because keep in mind, the Federal Reserve has made very clear that they are not going to ride to the rescue, at least not anytime soon, during this crisis. Historically, anytime something like this has happened where people have stampeded for the exits of money market funds, the Fed has stepped up to buy those U.S. Treasuries to restore liquidity to the market to keep the interest rates from blowing out higher. Well, right now, the Fed's goal is to send those interest rates higher so they wouldn't print money to stop that. And Joe Brown pointed out that maybe what Yellen is proposing here isn't to lock people below decks on the Titanic, but she might actually be proposing to create a whole new buyer of treasuries so that when people sell these products, there's no net effect on the bond prices because this new government behemoth would be stepping in to buy them. And that reminded me of this from back in September that was in Markets Insider, where Bank of America made a rather shocking suggestion. And I got to scroll down all the way to the end of this article where it says, it is not structurally sound for U.S. public debt to become increasingly reliant on Fed QE. It's risky, in our view, to rely on the Fed alone to solve the problem of Treasury market liquidity, resilience, and functioning. Now, up to this point, I'm in agreement with Bank of America, but after this first paragraph, is when they get a little wacky. Instead, Bank of America believes a better long-term solution is for the creation of a dealer of last resort that is not the Federal Reserve, which is governed by its dual mandate of price stability and low unemployment. In other words, B of A is saying, let's create a whole new government bank, not central bank, whatever you want to call it, that doesn't have to worry about pesky little things like unemployment or inflation. They'll just buy all the bonds in the world in order to prop up markets. What's the worst thing that could happen? Don't answer that. They went on to say, we believe such an entity should be formed before a crisis requires it. A dealer of last resort could make markets in a wide range of cash securities, futures, swaps, equities, bonds, foreign exchange, commodities, just like large international dealers do today. Great, because the Federal Reserve hasn't rigged markets enough. Let's create this whole new government blob that could just slowly absorb and digest all the markets, including commodities, stocks, and everything else. Why not? So as Joe is pointing out, it's possible what Yellen is talking about here in reducing the first mover advantage is she's advocating for the creation of this government blob to buy up all the treasuries so that when the first mover sells those bonds, the blob just gobbles them up and there's no net effect on price. Of course, that would be a hugely inflationary phenomenon, and it would be totally contrary to all the quantitative tightening and rate hikes that are currently going on at the Fed that have caused this liquidity crisis to begin with. This is just another chapter in the book of endless government intervention in markets, and it just seems like nobody out there is saying, hey, maybe the government should just take their hands off the scales and let's see what the market gives us. Let's find out what the actual natural price of some of these assets is, what's the actual value of money, what's the actual interest rate based on the actual risk, not some government bureaucrat's decision to create currency out of thin air and prop up markets. And there's one last thing I want to mention, and that is Janet Yellen is no longer a central banker. Janet Yellen is the Secretary of the Treasury. She's a member of the executive branch. She is a member of the Biden administration. She is now a politician, and every politician's primary goal is to get reelected. So it's entirely possible that all of these statements Yellen is making right now is nothing more than political jawboning to try to settle down these treasury markets in hopes of delaying a financial crisis by just a couple more weeks to get through those midterms without the whole economy collapsing, because all the polls indicate that right now the economy and inflation are the biggest issue on voters' minds. And once again, we're at this point where it's hard to really see which direction our leaders are going to take us. Are we going down the road of 1929 era deflationary market collapse or 1923 Weimar Germany hyperinflation? These next few weeks and these next few decisions by our leaders will determine which of those paths we go down. If you want to know a little bit more about that, you can check out this video I did about how this financial crisis will be like nothing else the world has ever seen. Until next time, live small and dream big.